Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, London UK feed wheat, and European processing potatoes. I'll start with Paris milling wheat. There was a lot going on here recently, and it hasn't stopped going on, though the direction may have changed. Okay, so we've had the upside targets for both the lopsided double bottom and for the bullish halfway hesitation. I am of course referring to targets X, X1, X2 and X3 on the daily chart. They will be retired after this commentary having been fulfilled. Since then we've had the fast rise of this market overcome three major resistances that no doubt will now have acted as supports. The 2007 to date downtrend currently at 244.5. The middle time currently 249.50 of the newly drawn March to early July bullish Andrews pitchfork, and finally the 2013 high at 253.5. Indeed, we have some clean resistance at 260, but it really don't see anything of note. Yet it was breached, but the unbroken 2013 high, with only a single close over it, managed to cap the market and push prices back down in between the twilight zone of below the middle time but above the broken 2007 to date downtrend. The market is trying to deal with this weird zone, which is why last Thursday was a counter to the counter day, and Friday made up a 2-day homing pigeon pattern along with Thursday. Now, 2-day homing pigeon patterns are interesting because traditionally they are seen as a bullish reversal pattern. However, data indicates that close to 6 out of 10 times these patterns tend to be bearish continuations. So it'll be interesting to if early this coming week the market follows tradition or data. Well, I'll just have to wait and see. One more thing to note, though it is a lagging indicator, we have had a second golden cross within 2 weeks. This time is a cross of the medium moving average, currently 216 even, over the long moving average, currently 214 3/4. A not insignificant one, I should point out. London UK feed wheat. The two bullish patterns I recently saw here, and which I spoke about and which fitted reality, though both seemed tenuous at the time, have seemingly run their course. First was the bullish shift pitchfork for the July action. It is thin, it is acute, and I find it hard to have confidence in any at an early stage or even love it. However, this small pattern dictated the bullish angle of attack throughout late July and until last week. Secondly was the July action as a bullish halfway hesitation. This was more promising but still tenuous. Target X for this pattern was in the 188.80 area, whilst the secondary target X1 was in the 191.70 area. These were also reached and will be retired after this broadcast. So, since the market peaked up over the flatlining long moving average, currently 195.80, and failed to make a single close up over it, prices have dropped away. However, this has been only done to the support of the old 50% Fibonacci line of the August 2020 to May 2021 move at 188 even, and just below the more recent and more potent 50% Fibonacci line of the May to July move at 189.45. Now, in the process of getting down there, we've had intraday indecisive actions out to the third level of countering action, as you can see. Notably, Friday being the second day in a 2-day bullish separating lines pattern. They once again closed over the flatlining medium moving average below, currently 191.95, and the old flatlining long moving average was overhead. I think overall the failure to have the minimum 2 consecutive closes over the long moving average has been key. Prices have managed multiple closes over the medium moving average, but this long moving average is still the obstacle and the one that needs to be watched. I might keep the broken bullish Andrews pitchfork on the daily chart for a little while yet, as I think there may be the chance that the market will run along the underside of the lower time, so just in case, keep a watch out for that. One of the features of using continuation charts on futures is that you occasionally get huge gaps after changeover. What is most interesting still above about the latest move up is that despite some large gaps, the bullish Andrews pitch for the November 2020 to March 2021 action is still valid. All that has happened is that the market moved up from the middle time, currently 18 even, tested the upper time, currently 22.7, failed there and went back down to the middle time support at the start of July. Since then, prices have tried moving back up but lacked the energy to really push higher to the upper time again. And we spent a long time back down now at the middle time and its new partner, the rising short medium moving average, currently 17.9. Interestingly, prices have also stayed within a band between the support of the 50% absolute Fibonacci line at 17.5 and the Fibonacci congestion at 18.5. However, Friday saw a big, if not in trading range, then in direction, move lower. Down through both the middle time, that is now resistance, as well as the short medium moving average. The drop even went through the important 50% absolute Fibonacci line and range support at 17.5, but closed right on it, in the form of an indecisive doji cross pattern. Now, this apparent indecision after making such a bold move lower is disconcerting. I would watch very carefully what this market will do. We should know more by midweek. Finally, I've drawn a new bearish June to August Andrews pitch hook. I'm not sure about it as yet, but it might provide some idea of any further attempts lower. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.